buy rating with a target price of 930 on the stock.
All right, bang on time. Thanks a lot for that. Well, that's the first tick on the index in the green for the Nifty, hanging on to 20,900. In fact, just within kissing distance of the 21,000 mark. The mid-cap index is having a better showing, up almost 0.5%. That's almost 200 points in the green for the mid-cap index, and all four indices are in the green. So after taking a bit of a breather for the last few days, the market has come back, and how. It's important to see if we build on to our gains, but for now, the going is pretty good. So it's a positive start. What's leading from the front is a lot of these power, renewable energy companies which are doing very well. NTPC is up almost about 1% odd. Adani Ports is up 1.5%. Adani Group stocks have been doing very well. Adani Enterprises also in the green. L&T is up about 0.5%. JSW Steel, M&M, Tech Mahindra, ONGC, ITC, Power Grid are a couple of other names that are in the green at the moment. What's not doing that well is two banks. ICICI Bank and SBI are a tad bit in the red. So that's why the Bank Nifty is not performing. And we were talking about how the Bank Nifty needs to perform for the market to get convincingly above the 21,000 mark. But there are some PSU banks which are doing well. So Punjab National Bank, etc. are in the green. Dr. Reddy is also trading a tad bit in the red. So keep an eye out on that. And there is plenty that's happening in the broader markets too. Just, a couple of these names. There's some news that's come in that the government has revised the wind repowering policy, saying that old wind farms with low-rating turbines will be replaced with new high-rating ones. Just pull up a couple of these names: Inox Wind, Suzlon, etc. Could be in focus. There could be some positive sentiment reaction because of this. So, just keep that on your radar as well. But other than that, it's a decent opening for the market. There you have it. Inox Wind up almost 2%. Suzlon also in the green.
Well, that's right, Sonia. A few more stocks to look at. IIFL Securities, that stock is up more than 10% in today's trading session. So big move being seen out there. We told you that Five-Star Finance is likely to be a large trade. That's taken place, and that's why that stock is down closer to around 3%. Sugar stocks, because of the cap in terms of potential ethanol production that will come out of them. You have Sri Renuka Industries, Bajaj Hindustan, Balrampur Chini, all of them under some pressure. The sugar production will go up, but the ethanol production will come down. Net, it's going to be a cut in earnings estimates. So that's why all those stocks are struggling a little bit. And the next order impact will be on Praj Industries, because that's a proxy play on ethanol itself. So that as well has lost closer around 5% as we speak. A couple of stocks as well that deserve mention because of high volume. GMR Power, well, that one is up close to around 5%. Massive volumes out there. And Paytm is bouncing back close to 2% after the kind of dropping that we saw yesterday. So fair bit of action from the broader markets. Headline index, though, is holding with a gain of around 50 points. And the Nifty Bank not moving too much. Waiting by for a cue coming in from the Reserve Bank of India governor. In the next 90 minutes or so, that event as well will be out of the way. Prashant.
Basically, Nigel, we are back at day before yesterday's levels. The high day before yesterday was 20,961. And the high today is 20,955, essentially. About 5 or 6 points away at the day's high. So can we build on this, or will we kind of wait a little bit more here after the rally that we've seen? Just a few more names before we go any further. Market breadth is very strong, so advances far outnumber declines. Look at Z Entertainment, if you can have that up. Z is up 4%. We were just discussing Z with Abnish 2 minutes back. Stock's at about 283. It's a big move. It's coming on the back of very strong and very large volumes as well. Yeah, there you go. That's Z. IRB is up 6%. So that's coming up again with huge volumes. IRB is up about 40, 41 or so. The Adani Group stock, which is off to the races once again, is Adani Total. Adani Total, of course, had lost the most and recovered the least. And that is up another 7.5%, ATGL basically. So we'll put that up. We mentioned IIFL Securities earlier. Orchid Pharma, I think we mentioned Orchid Pharma is up about 15%. So again, off to the races here. Big volumes as well, 650 in Orchid Pharma. Spencer's is up 7%. The stock's at about 107 rupees. I'm mentioning because it's got volumes on it. Nosil, which is basically ancillary to the auto space, rubber chemicals. That is, Nosil is starting about 3.5% higher. Very large volumes here coming through. And you've got something like a Reddington, which starts up big time as well. Now, on the downside, we already mentioned a few. I'll just take a few more to put on the list. Five-Star starts about 3.5% down. Five-Star, of course, is the Chennai-based finance company, 732, and been listed, I think listed earlier this year. You've got Praj, where sugar and of course Praj, the ancillary there is all under pressure, and I think that is to be expected after the news flow around here. MCX went up sharply yesterday. MCX starts slightly lower. It's about a 0.5% pullback. And Sterling and Wilson Solar, which has been running up one way, 5% circuits every day. That starts about 2.5-3% lower this morning. So that's basically the overall picture as we start this Friday's session.
I just one mention on IRB Infra, right? The stock is now one of the big movers in the broader markets. We mentioned that briefly, but 6% higher.
Yep.
And look at the volumes. Almost 2 crore shares are being traded on IRB Infra at the moment. The toll collection was very strong. Almost a 20% growth is what we saw in toll collection. And the management said that the second half of the year will be better. So commentary is also quite good. And I think that's why the stock is surging.
Well, things are looking pretty solid and lots of buzzers out there, as we've been pointing out. Tahir Barsha is now joining us, Chief Investment Officer at Invesco Mutual Fund. Tahir, great to have you with us here. Thank you very much for your time. Tahir, you've been steadfastly of the view that there are opportunities still in the broader markets, mid caps and small caps, even as others have kind of pulled their hand back. Just wanted to understand one of the things which I think is lesser discussed. We kind of talk about the overall picture, top-down view, mid-cap, small caps, valuations, etc. But as someone was pointing out, maybe the reason why the space is doing very well is because they much better represent sectors where there is a lot of activity, manufacturing, industrials, materials, right? As opposed to, say, the Nifty, where the weight of these sectors is much smaller. In the mid and small caps, the weight is much larger. Almost 0.25% of the mid-cap and the small-cap index is made up of these sectors. I just wanted to start with your thoughts on this, Tahir.
I couldn't agree more, and we've been kind of, pushing the case for mid and small caps primarily on that front. Our enthusiasm on mid and small caps continuing to probably perform. I mean, there could be obviously interruptions in between, but by and large, the cycle is basically predicated on the fact that the domestic economy is doing well, and we are intrinsically positive about the domestic investment cycle and the domestic economic cycle. And most of the mid and small cap companies, many of them, I wouldn't say all of them, but many of them actually are more levered to the domestic opportunity, not as much to the international or the global opportunity, which is probably more the case with some of the large caps, if not all of the large caps. So I think that's precisely what we've observed in the past as well. Even in past cycles when mid and small caps have actually done well, it has coincided with periods when the overall domestic economic situation has been better. And so I think that's the bedrock of our enthusiasm out there. So I'm absolutely on the same page with you on this.
Okay. Tahir, hi, good morning, and thanks for joining in. And this is a great time to be putting money to work in new sectors, right? Growing sectors, sunrise sectors as we call it. And one of the spaces which is doing very well is renewable energy. We were just talking about how names like Inox Wind are up almost 25% this week. Tata Power is at a new high. JSW Energy is at a fresh 52-week high. And these are companies that are doing a lot in the renewable energy space. You think the time has come for investors to put more money to work here?
Yeah, I think there are quite a number of opportunities, particularly on the ancillary side, even in the solar and the renewable space. And I think not just solar and wind, but or renewables as such, but even as you know, non-renewables and the traditional fossil fuel related power entities are doing much better now than what they were doing earlier. And it's all propelled by the fact that manufacturing in India has started to look up, and we've seen power consumption hit records in terms of growth after a very long period of time. So I think this whole area will probably buzz, and there will be opportunities. There will also be newer companies which will probably seek the capital markets. So we have some exposure to some of the traditional as well as some of the renewables as well in our portfolios. And I think you're right that this is also the space which will keep attracting attention from the newer category.
Hi, Tahir. Good morning. What about the PSU basket? The total market capitalization of these companies, put it together. Yes, we have an LIC that's been included in the last 18 months or so. It's 50 lakh crore. Now, valuation-wise, some will argue that still that entire basket is quite attractive. But sometimes, you have government interference, change of policies that makes things tricky. From the PSU basket, do you all still believe there is value in select pockets? If yes, which are they?
So, Nigel, in our scheme of things, in our definition, actually, PSUs, we run a PSU fund, by the way, as you know, for a very long period of time. And up until a couple of years ago, PSU and the fund itself was basically premised on the fact that it was significant value. It was trading at valuations which were below their own, historic valuations level on the market. They've always traded at some discounts to the market in general. But from there onwards, I think we've seen performance, and performances essentially come more on the back of now the growth visibility in many of these PSU-related entities, because they dominate some of the so-called commanding heights of the economy, and therefore, they are obviously the natural beneficiaries. So once again, going back to the fact that these are domestic sector plays. And but now for us, what we are saying, at least as far as the whole PSU space, is that we are not necessarily buying them now for that absolute value which was available a couple of years ago, or up until a couple of years ago. It's more a growth play now. So you have to pay them for their growth. You have to pay the valuations for the growth opportunity that you have in front of them. In several of them, whether it is some of the industrial, it is maybe even in some, maybe perhaps in the oil and gas space, I think we can still seek some value as far as PSUs are concerned. But by and large, I think for most others, it is now a growth objective.
Tahir, actually, yesterday, Sridhar Sivaram of Enam was making exactly that point. He actually took your fund name. He said it. He said Invesco runs a PSU fund, and we were asking him how best to get exposure to that space, and he said, "Well, that's a great way to do it." Kudos to you guys for having, and it's a smaller fund, so it still gives you opportunity to do
yes,
well.
And we've got a very stellar record, I would say. I mean, I've been surprised at times that when I look at some 7-year, 10-year performances, I find the PSU fund has actually beaten the Nifty. I mean, I wouldn't have probably imagined that.
Yeah.
So come through. So that's something which is.
You said incrementally, there's in PSUs, oil is the sector where there's still perhaps upside, right?
I would think of them as value, not as much of growth. We would buy them for value proposition, whereas most others have actually, now you have to think of them in terms of whatever you are paying, is it adequate from the point of view of the growth that they're likely to demonstrate?
But when you say, got it. But when you say value, you mean because of the dividend yield, etc., by that metric, or because values can stay value unless it is people start to value that value.
Yeah, absolutely. So
there's got to be that growth element as well. But you're saying there's not that much growth element here. So go on.
The good part now in PSUs is that there is value with some triggers. So you at least have some catalysts which actually can, as you rightly said, crystallize that value opportunity in the market. And that's exactly what they were at some point in time. Some of the other sectors in the PSU bucket were, but they now moved on to being more of growth entities, and what we would like to incrementally buy them for is probably the growth opportunity that they provide.
Okay. In fact, Prashant, you were talking about the Invesco PSU equity fund, right? If you look at the performance, in the last 1 year, the compounded growth rate is about 38%. The last 3 years is 31%. So it's been pretty stellar. By the way, that's the governor walking in and all ready to give the RBI policy announcement that happens in just a while from now. We'll be hearing from the RBI. Of course, there's no move on rates expected this time around, but any commentary, because see, inflation is cooling off, and any kind of indication on a change in stance is something the market is perhaps waiting for. In any case, rate cuts are expected from the second half of the next fiscal. But, okay, we have about 30 minutes to go before the RBI monetary policy. But Tahir, I just wanted to, close that loop on this whole PSU space. We were talking about how the funds are doing very well, right? So in that context, there's been a 30% compounded growth rate that we've seen in the last 3 years for this PSU equity fund. In case someone has not invested yet, does it still make sense to do so?
Yeah, I think the backdrop is pretty solid that we have in front of us for the PSU segment to thrive from a growth perspective, and most of the elements, as we all know, are in place. Of course, it's always a little difficult at such times when you can't see any risk around the horizon. So you have to be also a little watchful. But I would like to think that we are in a good space as far as the opportunity is concerned, and most of the factors which actually drive PSU performance, both from the point of view of growth as well as value, are available. So I would like to think that there is still, up until the time that we have this domestic cycle, which is strong enough, I think they will continue to do that.
Okay. All right. Final question, Tahir, from my end before we let you go. What's the view on IT from here on? The sector has been quite strong given the kind of news flow. That there are still fears that maybe, in fact, 2024 will be a year of slowdown. How do you approach the tech companies?
Yeah, we are as confused as you are. And, So I think at least we take comfort in the fact that they will come back. I mean, they've got business opportunity in front of them, and they are obviously sitting on a good amount of business visibility. Except that they have to contend for some delays in the short run. We are somewhat watchful as far as the U.S. cautionary, I would say, as far as the U.S. economy is concerned, and things can get a little pushed back. Earlier, we were expecting a first quarter, second quarter kind of performance out of the IT companies, but probably now it looks more like it'll get pushed into the second half of the year. So there's still time, but there could be some opportunities even within that space where the growth is a little more stronger, stickier, and they're not necessarily getting bogged down by delays. So some of the R&D companies, for example, are doing reasonably well. A few others too, even in the mid-cap space, for example, in the IT sector. So I think, it's a bit of a wait and watch out there, I guess.
Tahir, the other space where there's so great deal of optimism, and by the way, Sonia is going to later on Editors Roundtable put out a piece on that, which is essentially, I think, the rise in demat accounts, right? New investors who've kind of come in. Capital market plays, very bullish kind of sentiment out there. Tahir, so just what's the best way to capture that value, in your opinion? I mean, if equity markets stay buoyant, more people come into the market, I think, it's a space which will do well. There is exchanges, there are depositories, there are mutual fund plays, wealth management. But what's the best place to capture it?
So I think much of this ecosystem that you mentioned and most of these constituents actually are well placed, and we have a reasonable exposure to almost all of these constituents. So we're taking a somewhat diversified bet even within that space. But by and large, I think there are some where probably the regulatory risk is somewhat lesser. Regulatory risk probably in terms of pricing related risks or a few of the other things are perhaps a little better compared to some of the others. So to that extent, we've kind of, we've calibrated our exposures within that space. But I would like to think that obviously equity markets, we understand better versus commodity markets. So that's, have a better handle, and everything around the equity markets therefore looks good. But much of the play actually is around equity markets that's available in the market today. I think some of these
which space is risk lower? Which space is risk lower within that's
the equity space? I mean, the equity space, the risk is lower, I would say. Plus, in some of the equity subsegments, the competition is also limited. We are dealing with a 2-player market, a 3-player market.
Okay.
Versus some of the others where maybe there are 30 players. So, you probably then have a somewhat better positioning out there.
All right, Tahir, we'll let you go on that note. Thanks a lot for joining us. Appreciate your thoughts here. And if we don't meet again, Happy New Year to you and your entire team at
Happy New Year to you guys as well at CNBC-TV18.
All right, thanks for that. Well, let's get some corporate action going. Remember, we were just talking to Tahir about the IT space. Coforge is the company on our radar. The company has given a 13 to 16% constant currency revenue growth guidance for FY24. To discuss how confident they are about achieving this and how is the demand environment, we have Sudhir Singh, the Chief Executive Officer at Coforge, who joins us now. Mr. Singh, always great speaking to you. Thank you for joining us on the channel. Most companies in your space are guiding for higher amount of furloughs in Q3 and Q4. How is the demand situation at your end?
Well, the demand for the industry for the last 5 quarters has been tough. At our end, we believe that the demand situation currently will allow us to deliver on the growth guidance that we gave for the year at the beginning of the year. You talked about a 13 to 16% growth guidance that we gave at the beginning of the year. Given the macros as they exist right now, and given the specific deal pipeline that we have, we believe we will deliver within that range. And in a year like this, I think all of us recognize that that's going to be a pretty remarkable achievement.
Right. Hi, Sudhir. Good morning. Nigel on this side. Always good to see you in. Well, between 13 to 16%, will it be at the upper end? As of now, what is it looking at? At the upper end or the low end? And also, if you could tell us scope for improvement on the margin parameter, do we get to 20%?
So, Nigel, we're very confident around the fact that even in Q3, which is a seasonally weak quarter, margins should see a significant upside. Q2, our margins went up by 160 bits over Q1. Q3 should again see a very strong improvement in the margins. Q3 is normally a seasonally weak quarter. So we do expect growth, but quarter three is going to be like every other quarter three, a tepid growth quarter. That's how we see quarter three. Quarter four should see a rebound given the deal pipeline and the deals that have already been locked in. And that's what's going to get us to the 13 to 16% range.
But where? To the upper end or the lower end?
We'll talk about that in the investor call, but definitely within the range.
Okay, within the range. Sudhir, hi, morning. Prashant here. You know, HCL Tech recently flagged off one of its clients going the captive route for their BPO operations. We all have been talking about for the last year or so the rise of global captive centers here in India. This insourcing, is that emerging as a bit of a risk at the margin or has always been there? How do you look at it?
We haven't encountered it across our client portfolios so far. We've seen the same reports that you refer to right now, but GCC setups have had a bit of a seasonality around them. Currently, there does seem to be more action on that front. But at Coforge, across the client set and the prospect set that we're looking at, we haven't seen revenue around the margins getting impacted because of those developments at all.
Okay, fine. I just want to understand a little more about the deal wins as well, Sudhir. You've seen 7 consecutive quarters of $300 million plus deal wins, right? How is the deal velocity right now? Do you think this is a level that you can maintain over the next couple of quarters, or can you even build on to this?
Over the last 7 quarters, the last 5 have been particularly tough on the demand environment front for the industry. And yet, the point that you made, we've sustained a strong order intake. We do believe that order intake level, that threshold of 300 plus or minus a few tens of millions of dollars is a number that we should be able to sustain. And I say that largely based off the back of the deals that we are already pursuing. We talked earlier also about the fact that the order executable number that we talk about every quarter, which is the signed order book for the next 12 months over the last 6.5 years, has had a very strong congruence to the revenue that we've realized in the subsequent 12 months. We believe that trend will stay and the deal velocity is likely to be in the same benchmark that it has been now for the last 7 quarters.
All right. Sudhir, what's the opportunity you're seeing in AI? You know, what kind of progress are you all making? And say in the next few years, what kind of contribution you can see coming in from this segment?
Well, AI at this point in time, the conversation seems to have moved. I mean, around March, if we have this conversation, the conversation is more around, is AI going to be a new tech set that is going to take revenue away? I think that conversation is behind us. We have a lot of very active conversations. Our own AI platform, Quasar, is up and running. We've already created 3 different modules, a cognitive AI module, a Gen AI module, and on the 11th, we're going to announce a responsible AI module that's coming in. Conversations continue to be thick, but you're not really at this stage signing AI-only projects. Almost every conversation that we have, almost every proposal that we submit, almost every proactive pitch that we make has, across the service lines that Coforge has to have AI as an integral piece of it. So to that extent, it's become vital. But are we signing AI-only projects that are material? The answer to that still would be no right now.
So that's interesting. So you're saying across all sectors, right? Whether it's BFS, insurance, travel, retail, there is some element of AI that you are using. But as a percentage of your revenues, what kind of contribution do you see from AI, from generative AI over the next couple of years?
Difficult to forecast at this stage. If I look at the state right now, not just the industry sectors that you talked about, across every tech service line, whether that's cloud infrastructure, whether that is next-gen ADM, whether it is data analytics, AI now has become integral to just the service offering that we have. We don't lead into AI or into cloud or a conversation around cloud without talking about the AI-based framework that we've created. So AI alone as a standalone is not a service line that we operate with. We look at AI as being embedded in all the, for lack of a better word, the traditional technology service lines that Coforge has always had. 2 years from now, I would suspect that AI-only projects are likely to start becoming material. At this point in time, almost every piece of work that we sign necessarily has an AI component injected into it right now.
You know, Sudhir, we had somebody from MIT Media Labs over talking to a bunch of us, and he's a professor there, and you know, they obviously see a lot of stuff happening in AI, etc. The conversation was around AI. They see a lot of stuff, out there before it comes to the market, etc. He said the next 5 years, the pace of change is suddenly going to jump at us at an unprecedented scale. So it's kind of at a takeoff moment, and suddenly it'll overtake us in very, very significant way. Do you feel that is true, or people in the field sometimes tend to overemphasize the very near term? What's your view, briefly?
I don't think there's any doubt around the fact that it's going to be one of the most powerful technologies that all of us have encountered ever. And that's a given. The question is, to what extent does AI as a standalone for IT service players like us become a revenue stream? My submission to you would be, it's going to be all pervasive. It is going to change every tech service line that IT service players have. It's not going to be a standalone entity where you just go out there and start selling AI-only projects at scale anytime soon. But everything that we're doing right now, everything that we're likely to be doing a year or 2 years down the line is going to be massively influenced by AI. No one's going to win. No one's going to survive, at least in our industry, unless we've trained our folks, unless we've built the right alliances, unless we have alliances with places like the University of Pennsylvania or the MIT Media Labs, to your point that we already have standing.
Well, that's a very important point, actually, you make. You have to keep up with the new technology, or else you'll fall way behind. But any indication of 2024 budgeting spends? Do you think it's going to be less than what we saw last year? Any signs?
I don't think under any circumstance it's likely to be lesser than what we've seen in the current fiscal. At this point in time, at least for most of the banks, most of the insurance carriers, even most of the travel majors, we do have a sense across the client base in terms of what the budgets next year are likely to be. The good news is it's not going to be any worse or any lower than where it was next year. I believe the jury is still out around whether it's going to be materially higher. There's nothing that we've seen so far that convinces us that there's going to be a significant turnaround and a very significant spike from the levels that we are at. The level where we are at, we believe, is going to be the base demand level going forward. The next quarter or two, that level is not likely to change, at least given the conversations that we've had. So there are, for lack of a better word, there continue to be headwinds, but they aren't getting strengthened on the revenue side. On margins, there are clear tailwinds, because with attrition numbers having gone down, I think the flex that we as industry participants have around increasing margins is improving. But revenue numbers, the demand macros are likely to stay where they are for now.
All right.
All right, so we'll leave it there. Interesting conversation, and I hope you come back with a slightly more deeper dive into this, the AI business, and how, as you said, so well put it, it's going to change everything in terms of how IT services companies offer and kind of do work for their clients over the next couple of years. Thanks very much for joining us. 73 points higher. We're at 20,975. So there's about 25 points away. We're basically higher than day before yesterday's level, the high point, and about 25 points from the 21,000 number. So very, very close by. Orchid Pharma is jumping about 15% or so. And I think there is an initiation report which has come through from Investec. Ekta is standing by with that. Ekta, morning.
Well, yes, Orchid Pharma has jumped higher in today's trading session. Investec has initiated with a buy and a target price of 800 odd rupees. They believe that they are building a CEF, which is cephalosporin. It's a type of drug, future and more. So they are set for growth, strong growth over the next 3 years, according to Investec. The new management, remember, Dhanuka's promoters have taken over Orchid Pharma. They continue to execute a turnaround strategy plus leverage their core strengths. So, for example, over the past 3 years, the management, 1, has tripled the EBITDA and 2, deleveraged the balance sheet. They forecast a 35% EBITDA CAGR for FY23 to FY26, which is making Investec bullish on the stock.
Thanks a lot for that, Ekta. Well, let's do one thing. Let us take a quick commercial break. But on the other side, we'll go full tilt on what to expect from the RBI policy. A whole host of guests are joining in to tell us what they're expecting from the much-awaited RBI Governor address later today. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence.
Hello and welcome to our monetary policy presentation coming to you straight from Mint Street, the Reserve Bank of India head office. Joining me from the CNBC studios in Lower Parel is my colleague Ritu Singh. We will have an array of guests joining us, but just to set the context, this time, as I have said before, the Reserve Bank Governor and the MPC are faced with what I would call a Rajasthani thali of good news. You've seen crude all the way down to $75. You've seen US yields which were riding high at close to 5% in the previous policy on October 8. Now a good 80 basis points lower, close to 4.1. India's growth is steaming ahead at 7.6%, much higher than RBI's or the street expectation. And core inflation, what the Reserve Bank watches very closely, is actually falling steadily down, 6% in January and now at 4.2. With so much good news, how do you make policy for good times is the question we need to ask ourselves. Over to you, Ritu. Good morning. Your poll said status quo.
Well, that's right. Good morning, Lata. I think that's widely expected now, a hawkish pause and no change in stance. If you remember in the last policy, yet again, the governor had reiterated that 4% CPI target and made it very clear that until we get there on a durable basis, there is no question of even considering, shifting to a neutral stance. So no change in stance, no change in rates, but the markets will watch out for what happens on the growth and on the CPI projections. On growth, because of the stellar second quarter numbers, there is expectation that it will be revised up marginally, not significantly, but to about 6.7, 6.8% kind of levels from 6.5%. And on CPI, perhaps some tinkering is expected, but largely the expectation is that will also be left unchanged at 5.4% for the year. But the focus is very much going to be on the prudential measures, because wherever RBI has sensed excesses, it has raised the risk weights in the case of unsecured loans, for instance, and also on liquidity. That's another area of focus. That OMO bond sale that was announced in October, is RBI going to act on it? What will they do about keeping liquidity, comfortable in the system? It has remained tight. So those are some of the non-policy measures that the markets will watch out for.
Oh, absolutely. I titled my own piece saying the Reserve Bank's talk will be more important than the MPC's walk. But we will have to wait and see. Our esteemed panel is with us. Two eminent ladies and two gentlemen. We have Lakshmi Iyer of Kotak AMC. We have Parul Mittalsena of Standard Chartered Bank and Indranil Pan of Yes Bank and Kaushik Das of Deutsche Bank. So two economists and two people from the market. Ladies and gentlemen, thank you very much for your time. Lakshmi, let me start with you. While I will be asking the economists what they think about the growth forecasts and the inflation forecasts, okay, I think we will get to Lakshmi in just a minute. Parul, let me address this market question to you. What has been troubling me for the last 2 days is that the Reserve Bank has surprised us in the last two policies. In August policy, the expectation was a hawkish pause, but nobody was prepared for the ICRR of 10%. Likewise, in the October policy, yes, hawkish pause, but we were not prepared that the governor will brandish the OMO bond sale threat. Can there be something out of the box this time? If yes, what?
Hi, Lata. You're absolutely right. Last couple of times, markets have been surprised on the hawkish side. The way liquidity tools were used, the newer liquidity tools were used to drain down market liquidity. Market is in fear. We've run out of what more can be done on the liquidity front to drain further liquidity out. From last MPC to now, we've seen a 1 lakh crore reduction in core liquidity already. So RBI have already done quite a bit. We don't think there are more tools or more requirement to do anything further from here. They have shown the path in terms of increasing the risk weights to reduce the unsecured lending, which was proliferating in the market. We think if something comes, it will be along those lines and maybe right now is too soon and doesn't have to come in the MPC. But we really have run out of options on what more can be done on the liquidity front. Maybe reiteration of OMO sales coming as and when liquidity situation moves in a direction where that becomes necessary. That in itself will be a little hawkish for the market.
Okay. Well, similar question to you, Lakshmi. We just lost connection with you. Parul and I were discussing that, hawkish pause in August and in October was as is. But there was that unexpected policy announcement, action, not policy, action announcement. ICRR hike in August and, at least brandishing the OMO sales weapon in October. Can there be some unexpected action in terms of hawkishness from the Reserve Bank?
Lata, hi, morning. So, they've already been selling bonds in the secondary market to the platform. And in some sense, it is, a surrogate version of OMO, just that the quantum may not be as high as an initial announcement of, a larger size of OMO. So I think that could be the only tingling factor from a market standpoint, because as you rightly alluded to and as Parul observed, that consistently in the last two policies, they've been tweaking or, at least jawboning towards the liquidity part of it. And now from a negative zone, we are kind of, toggling between a neutral and a negative zone. So I think that could be the only possible, maneuvering or tinkering around, if at all. But we also need to appreciate that currency in circulation typically tends to rise from now on till election. So I think you can't be completely oblivious to that situation. So does it really need a hawkish posturing given that crude prices are down, global inflation is on the mend? Caution is warranted, no doubt, but trying to jawbone towards major hawkishness, I'm not very sure.
Well, Mr. Indranil Pan, what do you think? Will it be more even than hawkish, the stance? And, of course, no changes expected on repo or the stance itself. What is your sense on the GDP and the CPI numbers?
Okay, so I think hawkish or not, we did talk about the crude prices coming down, but I think crude is not one of the most important determinants for CPI at this point in time. It is more the food and how weather-related circumstances are driving food prices higher globally and also domestically in the case of certain items, including vegetables and cereals and pulses. So I think the caution will definitely be there. In terms of the liquidity, they have been warning about liquidity for some time. And yes, I think the surprise of a CRR and the OMO was there, but we were not wanting to look at that direction, even though the RBI was pointing out to excess liquidity and its efforts to reduce liquidity. Incrementally, I don't think there is anything on the liquidity side at this point in time. It's very difficult for even the RBI to do a liquidity calculation at this point in time. And if the markets are expecting an OMO calendar, like I think they were doing even after the OMO announcement happened last time, I think that is not likely to come through. And liquidity will be very crucially dependent on FX flows, and it's very difficult to put a finger on that.
Well, Kaushik, what is your sense? What can RBI do out of the box? I think you had spoken about a standing deposit facility tweak. Is that something you're watching out for?
Yeah, a good question, Ritu, and good morning, Ritu and Lata. So the thing is, RBI has been announcing something or the other in every policy. It's never a complete status quo policy. So we are trying to think through what can come. So one possible way to signal their hawkish stance is to maybe narrow the corridor and raise the SDF from 625 to maybe 10-15 basis points higher. That also is not that meaningful in the sense that RBI has already effectively delivered a rate hike in the October policy by pushing up the short-term rates to 685, 690. So it's just a hawkish signal from RBI's standpoint if they raise the SDF. The other thing that they can do is maybe, force some, corporates to increase their hedging, ratio through banks. So there could be some macroprudential measures which forces banks to, kind of tell corporates to increase their hedging ratios, because there is a narrative that a lot of corporates are taking RBI intervention for granted and not hedging as risk management policy would need them to. So in case there is a problem later on the currency front, can they be in a different difficult position? So there could be some macroprudential measures on the forex hedging side. These are the two things I can think of. Otherwise, if they can announce an OMO today, Lata was talking about actually announcing something rather than kind of keeping it as a possibility. So if they announce an OMO of 10,000 crore, that could also come to the market. I mean, nobody is expecting an announcement of OMO yet, given the tight liquidity. On growth, I think they'll increase it to 6.8% from 6.5. Mathematically, whatever RBI has been forecasting, it could go up by 30 basis points. Inflation, I think they can hold on to 5.4%. The November number is supposed to be around 5.7, 5.8. So RBI possibly could manage 5.4 this particular fiscal year. What will be interesting is that they will possibly give out the July-September inflation number for next fiscal year, and that could be below 4%. Our own forecast is 3.7, because this year July-September was 6.4%. So you could get some positive surprise if the number comes at 3.7% because of base effect. So that is something which I'll look out for. Otherwise, it's more of a status quo policy, but with RBI, you never know. They can always surprise.
Oh, yes. I take your point entirely, Kaushik. It's a little difficult to do something ultra hawkish when your next forecast, the incremental forecast for CPI is 4% or sub 4. So it could be a little difficult, but nevertheless, there is the 6% inflation likely for November and December. So RBI in a tricky spot. My eyes are, at least one eye is cocked on the stock markets. We are just about 15 points away from that 21,000 mark. Mount 21,000 will be here, probably even as the governor speaks and announces that they also expect a higher GDP forecast. But this whole scenario is very reminiscent of what we had during Dr. Reddy's time, when the numbers came in good, but at that time Dr. Reddy warned, are we overheating? Let's see if the Reserve Bank governor also, the Governor Shaktikanta Das, takes a page from Dr. Reddy's book and tries to sound ultra hawkish. We will know in a few minutes. I think, Ritu, it's over to you. Governor, any moment, I think.
That's right. We just have a few seconds to go. So, we'll stand by for the governor just to sum up what our guests have been saying so far in terms of what can be done out of the box, perhaps some tinkering at the lower end of the corridor, the standing deposit facility. That's what Kaushik was talking about. The wider expectation is that there will be some tinkering with the GDP numbers as well. The current forecast is 6.5% for the year. Statistically, because of the higher number that has come in the second quarter, that could be revised up by 10 to 20 to 30 basis points at most. Not much change is expected as far as the inflation forecast is concerned. Currently, that is at 5.4%. No change in stance, of course, no change in rates, but you never know, cannot second guess the Reserve Bank of India, what they announce, whether it is the macroprudential measures or liquidity-related measures. The markets will be on tenterhooks to see what Governor Shaktikanta Das pulls out of his hat this time around. He's on your screen right now.
Namaskar. We are now into the 8th year of our monetary policy making under the new inflation targeting framework. If you remember, this was started in October of 2016. So 7 years are complete. We are into the 8th year. And on a personal note, if I can seek your indulgence, this would be my 32nd monetary policy, including the off-cycle meeting last year and a special meeting. And at the outset, let me also wish each one of you a very happy new year in advance. And this is how the statement reads. As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available which I have put in the footnote, so those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24, primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October, with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation in core gathered momentum during September-October and reached levels last seen in the fourth quarter of 2019-20 due to the combined effect of policy rate increases and reduction in cost push pressures across core goods and services. Going ahead, inflation outlook would be considerably influenced by uncertain food prices. High-frequency food price indicators point to an increase in prices of key vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices, and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by the government are also containing domestic food price pressures. Crude oil has softened considerably, though it may remain volatile. Taking into account these factors and on the assumption of normal monsoons, CPI inflation is projected at 5.4% for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first 3 quarters of next year, CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply-side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply-side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to Marginal Standing Facility, that is MSF, by the banks. In parallel, utilization of Standing Deposit Facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system, and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macro-prudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. On the financing side, foreign portfolio investment, that is FPI flows, have seen a significant turnaround during the current year, with net FPI inflows of $24.9 billion up to December 6, as against net outflows in the preceding 2 years. Net foreign direct investment, that is FDI, on the other hand, moderated to $10.4 billion in April-October this year from $20.8 billion a year ago. Net inflows under external commercial borrowings, that is ECBs, and non-resident deposit accounts are, however, much higher than last year. India's external vulnerability indicators exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period. India's foreign exchange reserves stood at $604 billion as on 1st December 2023. We remain confident of meeting our external financial requirements comfortably. I would now like to announce certain additional measures. First one relates to review of regulatory framework for hedging of foreign exchange risks. The regulatory framework for foreign exchange derivative transactions was last reviewed in 2020. Based on market developments and feedback received from market participants, the extant regulatory framework for forex derivative transactions has been refined and consolidated under a single master direction. This will further deepen the forex derivatives market by enhancing operational efficiency and ease of access for the users. The next announcement relates to framework for connected lending. The extant guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by the regulated entities. The next announcement relates to regulatory framework for web aggregation of loan products. The Reserve Bank had introduced the regulatory framework for digital lending in August-September 2022. The digital lending ecosystem also comprises of services that aggregate loan offers from various lenders, and this is called web aggregation of loan products. Now, this is meant for the guidance of the customers. It enables the customers to decide which loan product to opt for. Several concerns relating to such web aggregation of loan products which harm consumers' interest have come to our notice. It has therefore been decided to lay down a regulatory framework for web aggregation of loan products. This is expected to result in enhanced customer centricity and transparency in digital lending. Next announcement relates to setting up of a fintech repository. Financial entities like banks and NBFCs in India are increasingly partnering with fintechs. For better understanding of developments in the fintech ecosystem and to support this sector, it is proposed to set up a fintech repository. This repository will be operationalized by the Reserve Bank Innovation Hub in April 2024 or earlier. Fintechs would be encouraged to provide relevant information voluntarily to this repository. The next announcement, there are two announcements relating to UPI. The first one of them, the first announcement relating to UPI is for enhancing the UPI transaction limit for specified categories. The limit for various categories of UPI transactions have been reviewed from